Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Walgreens stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 23 billion market cap. They're trading at $26 a share, and they have 862 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had over $4 billion in 2020 and 2021. It was cut in half in 2022 and real low in 2023, only $141 million. They just completed their 2023 fiscal year. Their fiscal year starts 9/1 and ends 8/31. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that doubles from 2020 to 2021, then doubles again into 2022. But they have a really big negative in 2023. It looks like it was a rough year. We'll dig into their 10K in a little bit to understand why. Revenue is the sales for the company, and that's flat from 2020 to 2023. You would expect their revenue to go up, especially with inflation. It did go up from 2022 to 2023, but not nearly as much as it should. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $38 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company of $34 billion. We divide that by 862 million shares. And we get a calculated stock price of $39. They're trading at $26, so they're trading at a 33% discount. It is a buy according to the model. But this is the kind of stock that doesn't really move too much. Most stocks that pay a nice dividend don't move around too much. They have less upside and downside. We'll get a better idea of where they've been trading in the past when we look at their stock chart on Yahoo Finance. There are 9 companies in the same industry as WBA, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. You can see the rest of the companies in this industry are really small. They're a giant. I'm actually invested in PetMed Express. I'm down about 20%. Actually probably 30%, so I'm not too happy with that. Walgreens spends a lot in CapEx. If they buy the real estate for a new retail store, the cost of that real estate goes into CapEx. It's capitalized in the balance sheet and depreciated over its useful life onto the income statement. They're a bit leveraged. Their debt to equity ratio is 1.7. For every dollar of equity, they have $1.70 of debt. They pay a really nice dividend, 7.6%. Look at PetMed Express, 13%. They do generate the most free cash flow out of all these companies, but it's still a really small number. A lot smaller than previous years. If you sum up the other 8 companies, multiply by 10, you're still not even close to how big WBA is. They have a price to book of 1.1. That's stock price over book value per share. We can't look at that PE since they have negative earnings. A really weak price to free cash flow, 160. Because they had such a low amount of free cash flow. The way you calculate the 160, it's free cash flow over market cap, or a stock price over free cash flow per share. A really good price to sales ratio, 0.2. This means their revenue is 5 times their market cap. This industry has notoriously bad margins. That's why everyone's price to sales looks amazing. Except BIMI, they're 2.3, but everybody else is below 1. They generate a ton of revenue, $139 billion, but they're not really growing anymore. Their 5-year annual revenue growth rate is 1%. Let's take a look at their 2023 10K. Here's their income statement, 2021, 2022, and 2023. So you can see their sales are up in 2023. It was flat from 2021 to 2022, up a little bit in 2023 to $139 billion. Let's get a breakdown of this number so we know what it is. Here's a breakdown of their sales by quarter. The 4 quarters that feed into the $139 billion. So their best quarter was their most recent quarter, $35.4 billion. Really close to last quarter, also $35.4 billion. Their second quarter of 2023, $35 billion. And the first quarter, a little over $33 billion. Here's a different breakdown of the $139 billion. In the US, $110 billion of revenue. That is down from 2021, up from 2022. Most of their revenue is pharmacy, $82 billion. An example of that is prescriptions. And they also have $28 billion of retail. They sell things like toilet paper, maybe cold drinks, a lot of things they sell. And then they have their international revenue, the boots part. That was $22 billion. That goes up each year. $3.7 billion in pharmacy. So pharmacy is the smallest part. Retail, $7.3 billion. Wholesale is the biggest part, $11.2 billion. Pharmacy is down in international from prior years, but retail and wholesale is their highest. Their U.S. healthcare is $6.6 billion. That gives them a total of $139 billion. Let's go back to the income statement. All the expenses directly related to generating the revenue, the $139 billion, is $112 billion. That includes payroll for employees, the cost of buying products to put into the stores, the rent for each of the stores. So revenue minus cost of revenue gives you your gross profit, $27 billion. That is lower than prior years with higher revenue, so their margins are getting squeezed. Selling, general, and administrative expenses, that includes marketing, $34 billion. So they have an operating loss of $6.9 billion. That's not good. So they have a net loss of $3.5 billion because they received $1.9 billion in taxes, a tax benefit. That's why their net income is better than their operating income. On the bottom of the income statement is their shares outstanding, and that's going down. It was 865 million, now it's 863 million. Let's take a look at their balance sheet. Current assets of 15.5 billion, current liabilities of 24.5 billion. So their current ratio is well below 1. So that's not good. They're going to need to add some debt in order to fund their current liabilities. But a company like this has a lot of access to the capital markets. They can easily get debt. They can easily sell stock. And they also have lots of cash flow coming in as well. They don't keep much cash on their balance sheet, $728 million. They have over $8 billion of inventory. At any given moment, they're going to have lots of inventory on hand because they have so many stores and so much product is in each store. It gets turned over quickly, but at any given time, they're sitting on a ton of inventory, over $8 billion. Let's look at their non-current assets. PP&E, property, plant, and equipment, $11.6 billion. I think a lot of that is probably property. Goodwill is their biggest asset, $28 billion. Goodwill is the premium you pay when you acquire another company. So total assets, $96 billion, up from the prior year of $90 billion. Their biggest liability is operating leases, $22 billion. And you can see operating leases in the asset section, $22 billion. So a right of use asset is an asset they lease from another company, but they report it as if they own it. So the value of the asset is $22 billion, but they also owe $22 billion on that asset. So it's like a wash. It's a wash on a balance sheet, 22 minus 22, because assets minus liabilities gives you your equity. They have $11 billion of paid in capital. That's how much money they raised from selling stock. $33 billion of retained earnings. That's how much they made from running their business. They buy back lots of stock, $21 billion of treasury stock. So when they buy back their own shares, they put it onto the balance sheet as treasury stock. That's a contra equity account. It brings down your equity balance. Let's take a look at the statement of cash flows. The statement of cash flows has 3 sections: operating, investing, and financing. Let's look at their operating section. So for 2023, operating cash flow of $2.3 billion. That is down. 2021, $5.5 billion. 2022, $3.9 billion. Now it's $2.3 billion. And the way you calculate operating cash flow, you start with your net income or net loss, then a net loss of $3.5 billion. We add back depreciation and amortization, $2.3 billion. Remember that income tax gain, we have to minus that out because that looks like it's a non-cash item. But if they paid income taxes, like in 2021, then we add that back. Only the non-cash part of the income taxes. Those are referred to as deferred tax asset or deferred tax liabilities. It looks like they passed through a big impairment, $1.3 billion. That brings down your net income, but it's a non-cash item, so we add it back here. They had a gain on the sale of equity method investments, $1.9 billion, and we minus that out here. Usually if a company owns 20% to 50% of another company, then WBA would record their investment in that company as equity method investment. And they record that on their financial statements. If WBA owned 1% of another company, they would not use equity method accounting. They would use cost method accounting. It looks like they spent $6.4 billion in litigation, so they're adding that back here. Let's look at their investing section. They spent over $2 billion in PP&E, It looks like they sold part of their business. They received $1.8 billion. They sold some of their assets. They received $4.5 billion. And it looks like they acquired other companies. They spent $7.3 billion. So in their investing section, they had an outflow of $3 billion. In their financing section, they added $6.3 billion of debt. They paid down $9 billion of debt. They paid out $1.7 billion in dividends. And they only bought back $150 million of their own stock. I would have thought it'd be a lot more. So in their financing section, they had a cash outflow of $900 million. In 2021, they had a cash outflow of $9 billion. Let's take a look at the company on Yahoo Finance. Here's their stock price way back in 1980. A slow and steady growth over the next 15 years. Then from the mid-90s to 2001, it had a massive growth, over $40 a share. Then it dropped to 25 by the beginning of 2000, and it ran up to its highest point in 2015, close to $100. And you can see how much a stock has struggled since 2015. It's down about 75%. It had a nice pop in 2018. It was 60 in June, then it broke through 80 in November. But this is the past 5 years, so you can see the stock has really struggled. It hit about $20 just a couple months ago. So it's trading well below its all-time highs. And it's also trading well below a year ago and 2 years ago. You can see their market cap has been falling steadily. It was $36 billion in November 2022. The following quarter, $31 billion, then $26 billion. Its low was in August at $22 billion. It is up a little bit since then at $22.6 billion. Their forward PE also looks really attractive, from 9 to 8. All their price multiples are getting really, really low. Price to sales 0.16, price to book 1.13. And look at their enterprise value over revenue, from 2 to 0.4. A pretty low beta, 0.75, so the stock is not too volatile. It's down 32% in the past 52 weeks, while the S&P is up 24%. The 52-week low is 20, the high is 39. And the stock is trading above its 50-day, but still below its 200-day moving average. So I think the next pop is soon, so you might want to get in before it goes up to 40. A good amount of trading volume. 13 to 15 million shares are traded each day. Of the 860 million shares outstanding, 715 million are on float. 17% held by insiders, 61% held by institutions, and 7.5% of the shares are shorted. A really high dividend, over 7%. 38% of their earnings are paid out in dividends. They just paid a dividend recently on 12/12. They've done 6 stock splits, all 2-for-1s, 83, 85, 91, 95, 97, and 99. So it's been about 24 years since they did a stock split. They've been paying a dividend for almost 40 years, 1 penny in 85, and then they raised it to 2 pennies in 91. Then in 1995, 3 cents per share, and then the next raise was in 2000, 4 cents, and then 5 cents in 2004, up to 7 cents in 2005, then 8 cents in 2006. So you can see they raise it every single year. 34, 36, 38, 40, 44, 46, 48. So they're currently at 48 cents. They've been at 48 cents since August 2021. So they're due for another raise. Let's take a look at the stock on Simply Wall Street. Its last price 26, market cap 23 billion. Down 32% in the past year. Let's see what they say about the company. They operate as a healthcare, pharmacy, and retail company in the US, the UK, Germany, and internationally. It has 3 segments: US retail, pharmacy, international, and US. I think they mean US healthcare. It's actually down here. They just put the word healthcare down here. I guess it's a formatting thing. The U.S. retail pharmacy segment engages in operation of the retail drugstores, health and wellness services, specialty and home delivery pharmacy services, which offers health and wellness, beauty, personal care, and consumables, as well as general merchandise. The international segment offers sale of prescription drugs and health and wellness, beauty, personal care, and other consumer products outside the U.S. Also operates pharmacy-led health and beauty retail businesses under the Boots brand stores in the UK, Ireland, and Thailand, as well as the Benavides brand in Mexico and the Ahumada brand in Chile. The U.S. healthcare segment provides Village MD, a national provider of value-based care with primary, multi-specialty, and urgent care providers, serving patients in traditional clinic settings, inpatient homes, and online appointments. Shields, a specialty pharmacy integrator and accelerator for hospitals, and CareCentrix, a participant in the post-acute and home care management sectors. Walgreens Boot Alliance was founded in 1909, headquartered in Illinois. Simply Wall Street is a lot higher than me. They're at $57 a share. They say it's 54% undervalued. 14 analysts priced this stock at $26.64. They say it's slightly undervalued. Here's their revenue since 2013. It was $71 billion. And then it grew a lot to over $100 billion, $116 billion in 2016. Then it grew to $136 billion in 2019. Which is pretty close to where it is now. Now it's $139 billion. And the forecast for 2026 is $156 billion of revenue. Here's their debt since 2013, $6.4 billion. It peaked at $19 billion in 2016. Then their debt came down and went up, then came down and went up again. It usually goes up when they acquire another company. Now it's down to $9 billion in 2023. But you can see their equity is always higher than their debt, which is good. Because $9 billion of debt is bad if you have $1 billion of equity, but $9 billion of debt is fine if you have $28 billion of equity. And you could see sometimes they have a lot of cash on their balance sheet, but currently they're not sitting on too much cash, only $700 million. Not much insider activity in the past year, a small sell and 2 small buys. 10,000 shares is not small for us, but it is small for an insider. 58% of the companies held by institutions, 1/4 by the general public, and 17% by private companies. The biggest shareholder is NewSip. I think the CEO controls this company, NewSip. Not the CEO, the chairman, Stefano Pessina. When Walgreens acquired his company, he got all this stock. So when companies buy other companies, sometimes they use cash to buy the other company, sometimes stock, sometimes a combination. Vanguard owns 10% of this company, BlackRock 7.6%, Invesco 1.7%, UBS, Union Bank of Switzerland 1%, Schwab, Eaton Vance, a lot of big names. They do employ a lot of people. It was over 210,000 in 2013. It peaked at 370,000 in 2015. Now it's 268,000. The ticker trades in lots of places: the Nasdaq, Deutsche Börse, Mexican Bolsa, Zitra, London Stock Exchange, Wiener Börse, EuroTLX, BATS Europe, Sao Paulo Bolsa, and the Buenos Aires Stock Exchange. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.